Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is logistics receivables, factoring for Calgary warehousing firms. When you warehouse goods for multiple shippers, receiving payment 30 to 60 days after delivery, you still need cash today for labor, racking expansion, and equipment maintenance. Invoice factoring can bridge that gap. Here's how Calgary warehousing operators can leverage factoring to turn receivables into working capital. 1. What is invoice factoring? Mechanics. You sell your approved warehouse service invoices, storage fees, handling charges, value added services to a factoring company. They advance 80 to 90% of each invoice's face value, often within 24-48 hours. When your customer pays, the factor remits the remaining balance to you, minus a small fee, typically 1 to 3%. Recourse versus non recourse. Recourse factoring. You retain credit risk if a customer defaults, fees are lower. Non-recourse factoring. The factor assumes default risk. You pay a slightly higher fee for protection against bad debts. 2. Key benefits for Calgary warehouses. Immediate liquidity. Free up cash to cover payroll, forklifts leasing, or yard maintenance without drawing on term loans or lines of credit. Growth enablement. Scale into new base C or D space, purchase additional racking or invest in WMS software ahead of invoicing. Outsourced collections. Shift dunning and payment follow-up to the factor, letting your team focus on operations and client service. Credit management. Many factors assess shipper credit profiles, protecting you from taking on new accounts that could become late pay risks. 3. The factoring process. 1. Onboarding and approval. Submit your top customers for credit evaluation. The factor sets advance rates and fee schedules. 2. Invoice submission. After you complete a billing cycle, you forward copies of signed bills of lading or warehouse receipts to the factor. 3. Advance funding. Receive 80 to 90% of the invoice value, often same or next business day. 4. Collection and settlement. The factor collects payment under original terms. Once they receive funds, they remit the remaining balance less fees. Choosing the right factoring partner. Industry expertise. Select a factor experienced with 3PL and warehousing, familiar with storage rate structures, handling surcharges, and inventory lien holds. Advance rates and fees. Compare advance percentages, fee scales, flat versus sliding, and any application or wire costs. Service levels. Evaluate their dispute resolution process, remittance reporting, and responsiveness to your inquiries. Contract flexibility. Look for month-to-month terms or easy exits. Avoid multi-year lock-ins if your customer mix may evolve. Best practices to maximize ROI. 1. Clean billing. Issue accurate, complete invoices immediately upon service completion. Include client authorization, storage SQs, and any special handling notes to speed verification. 2. Customer notification. Inform shippers of your factoring arrangement so payments go directly to the factor, avoiding misrouted remittances. 3. Blend financing. Pair factoring with a small receivables line of credit to handle predictable volumes. Use factoring for spikes in throughput. 4. Monitor metrics. Track factoring costs as a percentage of revenue and measure your days sales outstanding DSO before and after factoring to ensure you're gaining efficiency. 6. 3 action steps. 1. Audit your receivables. Identify your top 5 contract clients by invoice volume and typical terms. Gather sample invoices and payment histories. 2. Solicit term sheets. Approach 2 to 3 logistics specialist factoring firms. Compare advance rates, fees, recourse options, and onboarding timelines. 3. Model cash flows. Simulate your next 60 days of payroll, facility costs, and capital demands against potential factoring advances to confirm you'll cover all obligations and maintain a buffer. Invoice factoring transforms slow pay warehouse receivables into working capital, powering your Calgary operations, smoothing cash flow, and enabling strategic investments without adding long term debt. If payment lags threaten your growth or service levels, factoring could be the flexible solution you need. I'm Haider Malik. Thanks for listening.